Listen only mode.
TGIF, everybody. Oh, it's Thursday. Okay. So, King Dollar, King Dollar, King Dollar, right? Larry Kudlow happy about Dixie making new highs on this recovery, on this move to the upside. Yes, Paul, I know. So 97.10, I'd have a hard time getting long the dollar. I liked it down here on the 3 drive. And I do think we're going to crack 97.5. I just have a hard time reaching for it here. And as you can see, even in the euro, you're starting to get, we haven't quite made new lows, but we're getting spiky action here. See, same as the dollar. So, it looks like we're going to make new lows. I would say the most anemic response, everyone saw what the dollar did. Swiss had a nice response, not confirming. Could be a short. I'm tempted. And so the dollar and the Swiss had a good response. Canada, not so much. And the yen actually had kind of a weak response to the strong dollar. All it did was rally back to the moving average, and it's coming off. So, I teach to short the weakness on strength and buy the strength on weakness. So I would diagnose Canada then yen as the two weakest responders to the spike that we have going on in the dollar. Everyone with me? Give me a Y if you are. And then I do want to talk about the S&Ps. They're trying to recover, but I want you to look at the weekly here. So last week I was forecasting what's happening this week. I was talking about an outside week. It started off okay on Monday and Tuesday, and even Joe Perry goes, Dale, you're it's pretty early in the week to be calling for an outside week to the downside, and Joe was right. And my idea was delayed a week, but so what? Here we are now. So don't predict, go with the market. And this is a pretty ugly week unless we could get really strong reversals to the upside. And the daily on the NASDAQ 100, the 70-80 level, that's a weekly, has a lot of things coming into play here, right? You have the 200-day that everyone's bullish against. That was Monday's low. That was this low. It's a 2-week off number. So 70-80, write it down. And NASDAQ 100 is going to be the first clean technical signal. Plus, you would have a reversal week to the downside there, too. NASDAQ's been showing relative strength to S&Ps and the Dow. It's been the strength. So anyway, I'm positioned in these. I did the Steve Volge type of trade where I've been scaling in underwater. This is a triple Q's bearish 3 times. So we'll see. There's your 1 hour. There's your 4. And, I'm not looking for a crash, but, at least a scalp here. Back to, I have confluence here, 13.5. But my targets, I think, are about here, 16.5. So, if you're an ETF trader, and I know we're a FX company, but we cover asset classes, you have to find something that, I could sleep at night doing these where I have a harder time, where I feel like I need to watch the screen if I'm trading futures. Plus, it's more forgiving. Like right now, I probably have an average of 11.80. So, I'm 34 cents underwater. And, I started this in here, lowest buy 11.22. So that looks good for a bearish ETF. And here are the banks, if the bonds are rolling over. So yeah, I think we could get 50% retracements on a lot of these bearish ETFs. So for a a senior citizen. It's my senior citizen asset class for trading directions in stocks. So thought I'd share that with you, and really look. I bet the guys are so excited about all meeting. I saw a picture of Joe with Greg and his friend in New York, and they're waiting for Steve to get there. So, guys, gals, if you're in New York, you can meet all these. You can meet Steve and Greg. I wish I was there. There's nothing like meeting people. So you have a chance to spend some time with someone who's just a voice to you every day. I know you feel like you know people when you talk to them, but there's nothing like meeting them. So this is an opportunity especially for a couple of the guys that are flying over, the Atlantic to be there. So try and make it. And they're not, it's content loaded, this expo. I know I've interviewed Boris. I think Boris Schlossberg is like keynote there. And, I try and bring, the best of the best in here to interview to help everyone, give them some intelligence gathering and maybe see a method, or, maybe even subscribe to someone else. Okay, so people say, Dale, why do you tweet other people's stuff? Why do we bring in people that most companies would say, hey, you're bringing in the competition, right? Well, you know what? So be it. I mean, just like you could have more than one account, and that's why you should also visit Forest Park FX and talk to Trent and Justin. If someone has a few services, I follow more than one source. And you know what else? It shows that we're trying to help you, and we have more than our own interests of you signing up with us when we bring in people that you could sign up with. Don't you think? What do you think, guys? If you know of any other company that has the confidence in their own work to open up the door to someone else that they might lose a subscriber, let me know, because I don't think it happens anywhere else. And you know what it shows is also the confidence in what we do. Because if we were insecure about what we did, we probably, people that are insecure, they closed the door. It's not an open forum. They're not bringing in other educators and traders and people with subscriptions to newsletters. So I think we're unique in that way. And I think it is a statement of conviction in what we do. And my conviction in what we do comes from the team. Best team I've ever worked with. And you guys know I've been around for 10, 15 years. All right. There you go. So if you haven't yet, at least take the trial. My philosophy is you really can't judge anything unless you give it 90 days, a quarter, and that includes money managers, whatever. Okay, so that's my pitch, but it's not a pitch, it's a belief. There's a difference. Yeah, that's true, Forex. I believe in collaboration and cooperation. And, when I was a younger, more jaded person, the only reason I wanted to know what other people were thinking is so I could fade them. Okay, that's when, I was living from the ego all the time. I'm not saying it doesn't sneak out anymore. Everyone believed in being an individual, standing on your own. We're taught that. It's ingrained in us in our country. But you know what? It's great to collaborate and work in a team. I believe in a team, and best team on the net. And market-wise, those are my thoughts. I mean, the thing I have the most conviction on, I just showed you, that if the S&Ps don't rally big to go back to unchanged on the week, and they finish around these levels or lower tomorrow, I think the beginning of the correction of this recent advance will ensue. So I'm real excited for the team. I don't, getting to meet each other, and I know that they're going to be successful, and they're going to be the new rock stars of the FX world in New York. So, Blake, I know you wish you could be there too, huh, buddy? Darn real estate.
I know. It's actually. So I'll give you guys first and foremost, I want to apologize for not being there for those of you that are going to be there. So this is the whole reason why I was holding off the whole time. I was actually supposed to close on my house well, it's been a moving target, right? So it was supposed to close last week. Then it was supposed to close on Friday. And then yesterday I just found out that the lender's requiring a termite.
Oh God.
A termite. Because in homes, there's two types of homes in Arizona. There's homes that have had termites and homes that will have termites. So it's part of where we live. And so the house that I'm purchasing has had termites, and it's already been treated. But since the warranty has expired from the treatment, the lender is requiring that I get another before. It's a funding condition, so it has to be treated and with a warranty, and then we go into funding. So
yeah, they could have told you that 2 weeks ago, but there's always like the loose ends, Blake. I know, I've been through it.
It is the loose ends, and so now the treatment happens on Monday during the Forex Expo, and then funding goes on to Tuesday. So the fact of the matter is, if I was in New York right now, I would be pooping Twinkies at the moment, and I would be freaking out, and I would not. So I'm, unfortunate. It's unfortunate that I'm not there because I did want to be there, but at the same time, it would have been. I don't know if I would have had to turn around, to come back or what have you. So, hold on. I'm just getting pinged really quick.
Okay.
Hold on once.
Who is that woman? Look at that website. Amazing.
Okay, so I don't know who you were talking about, but anyway, but needless to say, I just want to state that if you guys are going to be in New York, if you're out there for the FX Expo, I hope you guys really have a great time, and you have a great time meeting the team. This is Grega's first time in the United States. So it's pretty exciting, for him. I know for him to be there, and I know Steve. This is Steve's second time to the United States, and I think it's his second time in New York. So it'll be fun. It's going to be a really neat meeting for those of you guys that are going to be there, and I hope you can have a great time and meet the team. And obviously Joe's going to be a great host while he's out there. Holy cow! I just closed my Euro Pound, and it's just getting schnockered right now. So so I did close my Euro Pound short. I closed it right at 86. I just kind of was leaving it alone. In all actuality, I should have kept a piece on, but I took it off because next week we have such a big week with all the Brexit news. We have, on Tuesday, and correct me if I'm wrong, Stelios, if you're listening in, Tuesday, the market is going to be, or the market, Parliament's going to be voting on Prime Minister May's new Brexit, her new deal.
Yes.
Right. Which will probably get voted down, I'm assuming.
Yep.
Then Wednesday is going to be on leaving without a deal, and then Thursday is going to be in the extension vote. So I mean, with those three votes, and it's leaving EU without a deal, that's going to be a big vote. And then obviously, not a non-extension on Thursday is going to be another big vote. So, I decided I'm going to leave the euro pound alone. I want to be short. So just so everybody knows, I actually want to be short this pair. I want to be long the cable. I'm just being a little cautious. For obvious reasons. I mean, it's obvious why I'm, being a little cautious here. But and will I short the euro pound again? Between now and next week, I might. It depends. I want to be short. It just depends what the price action is. If I can get a good a short position off, if I get a move above 86.50 and I feel like this, that I'm, getting a good entry, up here, I might take a short. It just depends. I'm not going to chase it lower though. And I'm using these dips to take profits. And I've made some good money this week, actually shorting the euro pound, just scalping in and out of it. So, I've been selling rallies, buying dips, and it's worked out pretty well. And I was short, it's worked out just fine. Now the question is, what are we going to do from here? And you go into the ECB and what happened with the euro. I mean, what's happening right now is we already knew that the ECB, what they were going to do, and the euro has slipped as a result, and we're at the 78% retracement. I do think the euro is range bound. I'm a little nervous about being short down here. That's one of the other reasons why I closed up my euro pound, is because I am a little nervous about being on the short side down at these levels. And it's not that we can't continue lower. It's just when we were down here at 112.80, which was just we're obviously below that right now. I was just thinking, I don't know if I really want to be short the euro right down here, especially with the ECB press conference coming up in the next 10 minutes. And who knows what Mario Draghi might say. Cable is trading pretty heavy. We are still at the 38% retracement. We're holding it right now. If the pound, technically, if we get above 132, like right here, that would make me a little bit more constructive on the pound, on being long. And matter of fact, I probably would have stayed short the euro pound if the pound was trading above 132 earlier this morning. But because we weren't, I was like, why take on the risk? The cable is not playing out in this flag pattern, the longer term flag pattern that looks like this, at least not yet. So I was like, no sense in dealing with it at this moment. The Aussie, I shorted some Aussie overnight at 70.50. Now, I don't know if I'm going to stay short, but while we're below the 70.50, 70.60 level, it's bearish, and I think the Aussie is going to eventually break down. I think this is a currency pair that I do want to continue to play to the downside, down to the probably 67, 68 cent level, and maybe even further than that, depending on what type of China trade deal gets done. But I've been a longtime advocate of selling Aussie dollars. I think the Aussie is going to continue to be bearish. I think that any China-U.S. trade deal is going to have a negative impact on the Chinese economy, B, the Australian economy. So again, I think the Aussie is a good short. It's just being tactical about it, trying to get good prices. I think we're going to eventually see a breakdown. I'm hoping for that here today, but at the same time, if we get above 70.60, we might squeeze back up to 71 cents, which might offer even a better opportunity to be on the short side. The Kiwi, still range bound, not doing anything. The dollar Canadian, what a move yesterday. What a move yesterday with the dollar Canadian. We have this inverted head and shoulder pattern We still should be playing out to 136. I'm looking for dips below 134 to be long, especially if we get a dip down there today. I'm going to try to pick the dollar Canadian up on the long side. Again, I've been playing the Euro Canadian to the upside. I've been playing the dollar Canadian to the upside. This has been a really good trader all week. For those of us that are playing short Canadian dollars, long everything else, the one problem that we have right now is crude oil is rallying. And so, if crude oil can stop this, current rally, and it's trying to break to the upside. If the Canadian, or if crude can stop this upside move and reverse, then I think that's going to really help the dollar Canadian even higher. So you have to imagine the dollar Canadian isn't even selling off with the Canadian isn't strengthening even with crude oil doing what it's doing. What's up, Stelios?
That was me, Blake.
The
interrupter.
Got it.
The crude really spiked. Cleaned out a lot of stops yesterday in reverse. There was some type of bullish report, and I've been negative, and now I don't know what to do with it. So yesterday's candle kind of changed the picture for me a little bit. But under yesterday's lows, look out. But it did turn. It looks like maybe one more run towards the high. I'm not sure. So
I'm not sure either. But while we trade above $55, it's hard to be bearish. I want to be bearish.
Yeah,
I really do. I just I'm having a hard time getting the idea of being too terribly bearish while we're below that while we're above that $55. We get below $55 and then it's like we get through this support zone, then I really start getting bearish.
That's why I got out. You have the same triangle. See that line that you have there, Blake? It like poked through it. I thought we might have. Yeah. So, to me.
Yeah, I don't blame you.
Yeah,
I really don't blame you at this point. So one of the other currencies. I mean, look at the U.S. dollar, Norwegian krona. Again, I double dog dare the market to show us some weak crude oil prices. If we do that, this U.S. dollar, Norwegian krona is going to go higher. I know Stelios probably has something to say about it, but I'll tell you what: the U.S. dollar, Norwegian krona is not going down. The dollar Canadian is not going down with crude oil higher. And if crude just shows its hand and it shows a little bit of weakness, these two currencies, in my opinion, are going to go. The Norwegian krona, the Canadian dollar are just going to get rocked. And I think that
great point.
I personally think so, because you have to imagine that it's going to coincide with some not only with if crude weakens, it's probably going to coincide with some equity market weakness, which would be obviously it would be risk off, I think, and that's just going to spur further U.S. dollar, Canadian, U.S. dollar, Norwegian krona.
Like that's such great mentoring, because you ask yourself, when you look at the whole board and the whole jigsaw puzzle, and you notice an instrument that is not doing well with a tailwind, what's going to happen when it turns into a headwind?
Right. Exactly. Exactly.
Yeah,
that's my thoughts exactly. So,
if I may add one comment.
Oh God, here he comes. Here comes the Norwegian krona bull. Go ahead.
I was just going to say that I think the dollar itself is having a much bigger influence on the USD Norway and USD SEK and USD CAD than oil is. Actually, forget about SEK. But CAD and NOK, I think oil is having less of an effect to the price rather than the dollar. And the dollar is screaming today, so it's only natural for USD NOK and USD CAD to go higher. Anyway, just a thought.
No, that's a great point.
It is a great point, actually. But is that going to? Matter of fact, a lot of people are really worried about, like you said, forget the SEK, but a lot of people are really worried about Sweden's economy. And I don't know, I don't have as close of a read on Norway, but I know you've been extremely bullish Norway. But is there central bank looking the same direction as the ECB? And so anyway, it's going to be interesting to play out. I think technically it looks bullish, though.
I agree.
Okay.
I agree. For the short term, I agree.
Yeah, it does. One last thing. Let's just point out that the U.S. dollar, Japanese yen, we are in a range. It's still in a very tight range. It's hard to be bearish, but if this thing breaks down below 111, let's just call it 111.50, that's gonna probably say a lot of things to me. A lot of it being, we're going to be starting to look at potential reversal and risk.
Look at yields, Blake. I thought yields were going to climb back to 285 or so, and now it's like they're rolling over. They're rolling over again. So go ahead.
No, you're absolutely right, and I thought the same thing too. I mean, look, this is the bond market, right? Here's the 10-year.
Right.
We had this triangle breakdown. So, you're saying yields are going to go up. Yeah, bonds were breaking down. And then we pivoted off of this big support in the bond market.
Right.
And now we've reversed and bonds are breaking out to the upside. Yields are coming down,
Yeah. Built a case for at least a correction in the yen.
Yeah. I mean, and I know with US Japan trade negotiations coming up, one of the biggest contentions right now is with the U.S. is going to be the yen and its currency. No, it's currency, and they're gonna want a stronger yen. They're gonna, the U.S. is gonna try to, get a stronger yen. Let's see what the BOJ does about that. Or Japan says about that, and that's might be one of the reasons that the dollar yen is just not selling off is because one of the trade tactics that the U.S. is going to try to employ is to try to get a weaker a stronger yen. So would it be stronger yen?
Blake, good morning. I don't think that Japan is really looking for a weaker yen at the moment. If they did so, they wouldn't be hedging starting this year the currency exposure of Japan. When JP, the pension fund, the Japanese pension fund, which, as you know, is like huge in size, and it's been doing a lot of foreign asset buying. Starting this year is now hedging their currency exposure, which is definitely a tailwind for the yen, not for the USD yen, for the yen. So I think that if Japan was worried about the level of the Japanese yen, they would definitely not have let that happen. So I don't think that Japan has any problems with the yen strengthening a little bit, or at least they don't seem to have any problem. On the other hand, the US is a very good ally of Japan, and they don't seem to want to pressure Japan in any direction on that side as well. So I don't think there are many political pressures for the USD yen at the moment.
Yeah, well, we'll see, man. I'm just, I guess I'm trying to build the case with maybe that's why it's so stagnant at the moment and not being affected by anything else, or anything whatsoever. But with that being said, hey, Steve, I'm going to pass it over to you. I know this is going to be your last. You're leaving after today, so tomorrow you're not going to be here, right?
Yeah, absolutely. Yeah, unless you want me to lose the plane.
No. So,
yeah.
so guys, make sure you stick around for Steve. This is and say your goodbyes to Steve. We won't see him for a good several sessions. Have fun in New York, Steve. I'll talk to you on the side note between now and then. But have a great trip and have fun in New York.
Thank you, Blake.
All right.
Good luck today, Blake.
Thanks. Good luck to you guys. Bye-bye.
So we have some data in about 10 seconds. Hello, Coach. How you doing?
Oh, good, buddy.
Hey, Dave.
Hey,
we
Steve.
have some data out of the US and Canada in about 5 seconds. So let's have a look at that before we continue.
Okay.
Unit labor costs, jobless claims, non-farm productivity out of the US. It's a bit slow. It's not showing yet.
Well, Blake, Joe, and I are pretty productive. We're in the US.
Oh, there we go. All green for the US. So jobless claims better, non-farm productivity 1.9% versus 1.6. Unit labor cost 2% versus 1.6. So that's good data for the US. Minor revisions lower, but really they don't matter that much because it's very small.
Anything big happening actually. Building permits worse than expected from Canada's side, by the way. So
I don't have that number actually yet. I'm looking at our calendar and I don't see it. Okay.
So USD CAD, we had discussed about this, that USD CAD was in that triangle. So whichever side it broke, it should have produced some continuation, and indeed we're seeing that. And imagine USD CAD is pushing higher while crude is holding up very nicely. So imagine when crude actually rolls over, we should see a lot more strength from the side of USD CAD. Stelio, I think it's a good opportunity to discuss a little bit about the ECB, before Draghi starts his presser, which is going to be any moment now. We had some dovish developments there, right?
Yes, they left rates unchanged. That was, expected. But they announced the new set of TLTROs. So this is the targeted long-term refinancing operation. This is the third one they've done. And it's going to be starting September 2019 until March 2021, if I'm not mistaken. And this is, for the people who don't know, this is money that the ECB lends to the banks, and with the proviso that they lend it to the real economy. That's why it's targeted. That's what the T stands for. So they lend it to companies, and they take that cash, they lend it to companies, and actually, instead of paying interest on the cash that they've borrowed from the ECB, they get refunded at the deposit rate, and the deposit rate is minus 40 basis points. So they actually get 40 basis points back for doing that. The banks do. So that's what happened. And actually, the interesting thing is that it was kind of expected that they might talk about TLTROs, but the fact that they would have all the details, would announce
it immediately. Yeah.
Yes. And also, the ECB had said, this is quite interesting. They had said I think it was only a few weeks ago, that only a serious economic shock would lead to further policy action. And here we are with further easing action, and you have to wonder, are they seeing a serious economic shock, or were they just saying it? So this is what's been happening, and now
regardless, it was a dovish surprise. There's no question about it. As you said, there was a lot of discussions about it, but nobody expected that we're going to have an announcement with so many details. By the way, Draghi just started speaking, Stelio, right?
Yes. So if anything big happens, or any good,
please interrupt at any given point. Obviously, given the previous developments that we already discussed, Euro USD is pressing lower, and I'm monitoring at this red trend line that you see. We're very close to this, so 112.40, roughly an interesting area of support, and below that we have the confluence of the 61.8 of the move higher that we had from the beginning of 2017 to the highs, which was in February 2018. So that's the 61.8 at 111.90 almost. And at the same time, this confluences with the extension of this large blue channel that actually capped price action from the beginning of 2015 until the summer of 2017. So those two levels coincide roughly at 111.90. That's in essence, the line in the sand. I think that the break below that should extend losses. I'm pretty sure that a lot of limit orders, stop losses, etc., reside below that area. So bulls really need to defend that general area around 112. Let's see now if Draghi can actually produce some more downside pressure with his with his press conference. Stelios is going to keep us up to date. So until that happens, we can obviously start looking at other stuff. Yesterday, we finally had some continuation lower for stocks. This was more or less expected because we had already seen the first sign, which was a clear loss of momentum to the upside. So now, as you see, S&P has broken below this ascending wedge. The same deal more or less with Nasdaq. It's attempting to do so now. IWM had done so several days ago. So as you see, the IWM did get rejected from this nice support resistance area at 160. The DAX, on the other hand, and of course the DAX is going to be helped by euro weakness, is still maintaining its price very close to the recent highs at the inverted head and shoulders formation. So it's holding out quite nicely. Same deal with the FTSE. So as long as the dollar is overperforming, some overperformance from the European stocks in comparison to the US stocks is to be expected. And here's the Dow. Dow now has broken below this ascending channel. We had already seen here as well some signs of momentum loss. So let's see if we're going to get some continuation lower, and most importantly, let's see what kind of a move this is going to be. I mean, I'm looking very actively to see if the move lower is going to have impulsive or corrective characteristics to actually determine what to expect in the days ahead. Having said that, let me open USD CAD, because USD CAD is one of the big movers. Yesterday we had a big extension higher. I know I didn't actually catch up everything that Blake said because I was in a meeting with Joe, but I know that he spoke about USD NOK because I was here. So the same situation, USD NOK and USD CAD, despite what we said yesterday and Blake repeated today. If you remember, I had said since some days ago that as long as crude remains trapped in the 55 to 58 range, you need to be cautious because there is still the possibility for more upside. But regardless, USD NOK and USD CAD have already started moving higher without seeing any real weakness from crude, which means that both of them are quite weak. And if at some point, not if at some point, when at some point, even from either from here or from a little bit higher, we see some deeper correction in crude, USD CAD and USD NOK should move significantly higher. So I think you should expect more underperformance from them. Now, I know that yesterday I didn't mention the metals because
can I
absolutely
interrupt for 1 second? We have two comments from Doug. He's being quite dovish actually, and the euro is dropping a little bit on the back. He did say that underlying inflation continues to be muted, and the weaker economic momentum is slowing the adjustment of inflation towards their aim. So basically, this is why they're adding more easing to their policy. And the other thing he did say as well just now is that the weakening in economic data points to a sizable moderation in the pace of the economic expansion. So this is they're a bit more bearish in terms of forward growth and inflation. So.
It's weird actually, because as it seems the ECB is quite a lot more forthcoming about their expectations in regards to the economy in comparison to the Fed. The Fed, I mean, I can't imagine the Fed being so openly pessimistic about the progression of the economy, but as it seems, the ECB doesn't have a problem doing so. The reason I'm mentioning this is I'm viewing this as a longer-term opportunity, meaning I think that this discrepancy between the way that the two central banks are approaching communicating the path forward at some point is going to create quite a lot of distortion between the expectations of the market for the US and the European economy. And I think, playing that spread in any given way at some point is going to be either by going long the Euro USD at some point in the future, or perhaps betting on overperformance of European assets is going to be a good opportunity, but not yet, because for the time being, indeed, the European economy seems somewhat weaker, although, as you know, my expectations for the US economy are no different. So anything else that he said?
Not at the moment. He did reiterate that near-term growth outlook is weaker than anticipated. So he's been quite dovish at the moment. Okay, cool. Let's have a look at the USD SEK as well. It was mentioned before, but we didn't have a look at it. The reason I wanted to show it is because, in my opinion, this was clearly another. There, you can see it here. This was clearly another corrective formation. So I'm expecting a continuation higher from there. After breaking through this triangle, seeing more upside was, to be expected. But, this formation was also corrective. So I think that we should keep on pushing higher. First objective is the previous high at 944. But I do think that we're going to at least make it to the 161.8 extension of this triangle's width, if not at the 100% extension, which comes at 981. So I do think, indeed, we have a friend here commenting that, I do think, indeed, that USD SEK should remain well bid in the days ahead. Now, having to do with gold, silver, and the metal complex, nothing has really changed. We've had now, so far, this is the third consecutive day. Of course, it's too early in the day, that we're seeing metals, at least the two main precious metals, gold and silver, consolidating the risks and losses. The obvious inability to rebound higher is actually telling me that we have more downside coming in the days ahead. So as you see, both gold and silver remain quite weak, and oppositely, gold-silver ratio is climbing higher, now testing a horizontal support resistance area. A break above this should actually bring us once again likely towards the long-term trend line, wedge trend line, which comes roughly at 88. So, as long as the two metals are doing good. Yeah, gold-silver ratio. And once again, as you see, Coach, gold-silver ratio's daily RSI has broken higher, about to test the overbought level. So this is another sign that,
it's got more juice in it.
It has more juice indeed.
Just one caveat, Steve. I was watching the action as the euro got slammed again. Just intraday, and it doesn't mean that much, but gold is not making a new low. With the euros, the low that it just made and high that the dollar just made. Maybe I'm talking my book.
Don't forget that theoretically speaking, the fact that we're seeing more dovishness, more, in essence, more loose monetary policy expectations from the side of the ECB should be gold positive, right?
Yeah.
Because
I'm just thinking, that it could set the stage for a rally back to 1300.
Oh yeah. At some point we can see a rally back to 1300. And to be honest, if you remember, I mentioned that 2 days ago exactly.
Yeah.
I will consider this an excellent sorting opportunity. So I'm actually crossing my fingers to see a rebound to 1300 because I'm absolutely, definitely sorting 1300.
Okay, that's what So anyway, that's what I see right now. Short term.
Yes, sorry to interrupt. We have the forecast from the ECB for inflation, for HICP. It's been dropped from 1.6% in 2019 to 1.2%. So that's quite a big revision lower.
Oh, yeah.
And 2020 from 1.7 to 1.5, and 2021 from 1.8 to 1.6. So
but what about 2036?
I know.
It's really important. I need to know, Stelio.
Yeah. Well, that's what they're doing.
I'm wondering, do they actually play darts when they're doing this? Because it's so stupidly ridiculous. In all honesty, I find no reason why they should issue any forecast past 12 months. Because the chances of them being right are minuscule, and the chances of them being right for the actual reasons that they've predicted them are even smaller. You know what I mean? I mean, they have a chance of being right but being right because they thought exactly why this would happen is even a lower chance. So it's completely pointless. But yes, the short-term revision from 1.6 to 1.2 is quite a strong one. Yeah, absolutely. Okay. So in essence, Draghi keeps sending strong dovish messages for the European economy, and obviously this guides forward for a much looser monetary policy. In my opinion, it's now 95% a given that the ECB is going to go in the next recession at zero rates, at negative rates, actually. Now, it's a big question. How exactly are they thinking of handling the next recession? Because, interest rates will have already reached more or less, the limit. I mean, there are already a lot of studies that, going more negative has very, has very a very high probability that won't have any big effect, and it might have more negative effects than actual positive. But let's see what they're going to do. So we're talking about more QE, obviously, then, and whatever. Ziggy says that with darts you can be more accurate. Actually, I'm in total agreement with that. Okay, so let's go. Let's have a look at the rest of the metals. So platinum actually produced quite a nice rejection. Platinum, you can even see it as a rectangle here, a little ascending channel or even a rectangle. Quite a big rejection from this 875 area. I mean, we've dropped literally like $50 within, what is it, like 4 trading days. So platinum remains one of the weakest, and palladium, on the other hand, it's playing on its own tune. So far, the move lower seems very orderly, very corrective. So remains the strongest one of all. Now, having to do with copper, copper more or less in the category of platinum, having to do with the short-term reaction. The short-term reaction looks corrective to me. So I still maintain my my viewpoint that as long as we remain above this breakout level, we should see more upside for copper. Now, there was a mention before, you mentioned it, I think, Coach, about what the bonds are doing. And actually, this is an interesting conversation to have, because here is the 10-year treasuries. As we see, we're testing once again this upper trend line of this triangle. If we actually do break above 122.5, I do think that then we should have that one last push higher that I was looking for towards the 61.8% fib, which comes almost at 124. I think there's going to be no real resistance up until that level. And if you have a look at the bonds remain very well bid. We did have like 3-4 days of a downside, but you need to remember here that the bonds, an equivalent technical situation as with the USD NOK, have broken above a very long-term descending consolidation, and that is a big development. I think that the bonds might produce a lot more upside, which bodes quite well with what we're seeing now from the ECB, having to do with their stance on monetary policy, having to do with their expectations for the European economy. Don't forget that the bonds, in my opinion, are not only the benchmark European bond, having to do with, run to safety, but in my opinion is the number one run to safety bond globally. If you're asking me if I would rather hold bonds or US treasuries, I wouldn't even think about it, for a second. I mean, between the two of them, bonds. There is no question about it. The German economy is much, much healthier than the US economy. So I do think that the flight to safety should favor, anyhow, bonds more than the treasuries, especially considering the fact that one of the things I'm taking into account is that if the US, if globally we go into a recession until 2021, in my opinion, an extremely high scenario, there is a huge likelihood that the next government is going to be in the US. I mean, it's going to be the Democrats. We've seen that the Democrats are leaning a lot more to the left. That means even more fiscal irresponsibility. Not that the Republicans have shown any real fiscal responsibility. They claim to be fiscally responsible, but during the last few administrations they've proven, not to be fiscally responsible at all. But especially if we go into a recession, Trump is going to be blamed for that, in my opinion, at a big extent unfairly, because the major problems of the economy are not his doing. Not that he did anything much to help with that. So electing a democratic government afterwards, I think, is going to create even more issues with the U.S. economy. While the Germans have proven that they are a lot more responsible. I mean, all sides of the spectrum of any of the parties in Germany that can actually end up in government, within the next few years, at least, that in the foreseeable years, are fiscally irresponsible. So I do think that Bunds should prove, any way you slice it, to be better safe to quality. Okay, so Bunds, I think should make it to all-time highs once again, and why not even push higher from there? Now, at some point, irrespective of how they perform one against the other, I expect that the huge bubble we have with bonds in generally, globally, I mean, either you have a look at, safe haven bonds, or even if you look at junk bonds or whatever, I think all of them are in a big bubble. At some point, the markets are going to figure out that bonds in general are overpriced. So we might have like a big move lower in bonds in general. But even then, I would expect the bonds to overperform the treasuries. Okay, let's see what else. Stelio, anything more that has come through the pressure that's worth mentioning? The Euro USD is more or less stuck at 112.60. So the Euro USD at least hasn't reacted further to any comments, but I don't know if we had any. Stelio?
I think he left.
Oh, yeah, to pick up his daughters, most likely.
Yeah.
Okay.
Draghi said, I don't know what any anchovies on my pizza. You think that'll move the market?
Yeah, probably not.
What do you put on your pizza, Steve? What do you like on your pizza?
Actually, unfortunately, I don't like vegetables. Unfortunately, since I was a kid, so I'm more of a meat lover.
Sausage and pepperoni and onion.
Pepperoni, bacon.
Yeah, okay.
Several cheeses.
Feeding your arteries.
Need to correct you. Check the records. U.S. deficit has gone down during Democratic control, goes up during Republican. Check history. Ziggy, yes, but don't forget that many of the implemented policies, usually produce results later on, right? Plus, don't forget that this is also decently, at least recent, in part of the big boom that we had during the Clinton years. That was due in a big extent to the big boom that we had in the internet, which wasn't, due to Clinton. Clinton was lucky to be in command when that actually happened. I mean, I'm pretty sure that even if there was a Republican, in office then, we would have more or less the same results. And if I remember right, in the Clinton year was the last time that the U.S. had actually a surplus, if I'm not mistaken, right? So since the Clinton years, we haven't seen a surplus from the U.S. And to be honest, from what it looks like at the moment, it doesn't look like it's about to happen, at any point soon. Irrespective of that.
Yeah. So I think the S&P is up top. Stock index is up top this week. Your view?
It's very likely. I mean, if you remember, and it's not by accident, I'm doing the key levels for the S&P. And just to give you an idea, even since we were here, I had put the bull bear line here.
Yeah.
So, for me, this is the key level. You know what I mean? As
right.
long
And look
as
at the weekly. Look at the weekly rank candle.
Sure. Let's have a look at it.
Hey, Steve, it's Joe. How's it
Hey,
going?
Joe.
Hey, I just want to jump in real quick and let you know. I know that Stelios jumped off, but
Speaking of that, give me a second, mate. Yeah, you're absolutely right. This is an outside black candle. So actually, the weekly candle is threatening with a bearish key reversal.
Yeah.
So yeah, you're absolutely right about it.
All right, man. I know your head was in New York, and making sure your hair looks good for when you're on Bloomberg and everything. So just wanted to bring it to your attention. Hey, Joe. Good luck
guys.
this weekend, buddy.
Thanks. I just wanted to let you know real quick. Draghi said that the probability of a recession is very low, and adds that the probability of de-anchoring inflation expectations is also very low.
So in essence, Draghi
kind of pulling back a little bit.
So Draghi, in essence, says the following: we're going to loosen more monetary policy. We're never going to hike rates because more or less by saying that they're going to extend it until next year, and we see, more or less says that.
Sounds like he's trying to temper what he said already.
But we're doing all that without worrying about the economy. Yeah, sure, right. I mean, the amount of BS we get from central banks is just astonishing.
I used to play a blues song by Johnny Lang called "Lie to Me" during Fed days, central banker days. Anyway, yeah.
Yeah. Joe, by the way, I know that you had something more to share with us, right?
Yeah, I just wanted to talk about a little bit about the Traders Expo that is coming up starting on Sunday, and I wanted to let you know that we will be live streaming it. So anybody who can't be there in person can watch our presentation online at 3:30 Eastern Time on Monday afternoon. Steve, if you want, I could show you how to get there. I think we're going to be putting on the website
yes, actually,
an area for you to sign up.
We're going to be putting this page in the website. By the weekend, we're going to put here the place where they will be able to watch the live stream. I just wanted to remind for one last time, if any of you want to attend the New York Traders Expo, it's for free. You can follow this link. And if you want to attend, if you browse a little bit lower, if you want to attend or get together, you just need to put your data, just your name and your email address in this little field here. And we're going to send you an email later today with information about where we're going to meet. It's going to be very close to the Midtown Hilton where the expo is happening. So you can come and get to know us, in person, and we can have a drink and, some food later that night on Monday, the upcoming Monday. So in this page, we're going to also put the live stream, browser or whatever it's going to be. We're going to get it later today, and they can watch it here. So where did you want me to?
Oh, go ahead. I'm sorry, guys.
Where did you want me to take you, Joe?
If you go to the Traders Expo homepage, just real quick, if you want to sign up before we have the sign up link on our page to watch the live stream, if you go to the Traders Expo homepage and you go to the full schedule, their schedule, go down to full schedule, and you just scroll down to our presentation, which is Monday at 3:30 p.m. You can actually, there's a button on the right-hand side there where you can click on, and you could actually sign up right there, and you'll get the link to watch it. But like we said, we are going to have it on our homepage, hopefully by the weekend. Keep going down further.
Oh,
There's
somewhere here.
Yeah.
A lot of stuff going on indeed.
Yeah, it's going to be a good time. I encourage anybody who's in the area to stop by our booth.
Did I miss it?
Right there.
Here it is.
See on the right-hand side there?
Yeah. Live stream. There it is.
So you click on there, and you could just put your email address, and they'll send you the link right there.
Absolutely. I'm going to put the link actually in the chat box. Okay.
That's a great idea.
Yeah, I put it in the chat box. Perfect. Great. Done.
Right. So anybody who can't make it, you can watch us and pretend you're there.
Absolutely. Absolutely. Joe is going to be there. Greg is going to be there. I'm going to be there. And we're looking forward to seeing any of you that, live in the area or you want to travel, for the weekend, for an extended weekend or whatever, and have some drinks together.
Yeah, and it's free. So even if you just want to swing by and say hi to us, that would be great. It would be great to meet some of our people.
Absolutely. Absolutely. As long as you promise to give them the Bloomberg stamps.
I don't know what you're talking about.
By the way, we have a comment from Joseph. He says, actually, I would suggest that Democrats are much more fiscally responsible than conservatives. The right has slashed revenue collection while still increasing government side. I totally agree with you. I totally agree with you. Theoretically speaking, the Republicans in the past were all about deregulation and slicing government size. So they can exchange that with slashing taxes. But lately, I mean, the last few administrations, they are actually slicing taxes while at the same time still increasing government size. And that's the problem. I totally agree with you.
Steve, I got one Twitter question. And Michael, I see you. Michael's in the house for our interview. On Twitter, Katsu Mokashi wants to know, I was listening to the webinar and Celiano said the German economy is much healthier than U.S. economy.
Absolutely.
Hence his decision to go with bonds. I don't know if he is on Twitter, but I'd like to know what was his reason to say German economy stronger than U.S. economy. Thanks.
Why? I mean, seeing it any way you want. First of all, there is a huge. This is a big conversation actually because it has to do with economics. There is a huge misconception that you can have. Not misconception. It's one of these BS things that they teach you now in economics, which in 50 years from now it's going to be the handbooks actually in universities are going to be saying the exact opposite. There's a huge misconception that you can have a healthy economy that is based. The GDP growth is based like 70%, 75% on consumption, and running huge trade deficits. That is completely stupid. I mean, there's no other way to do it.
Or that Keynesian theory?
Yeah. The German economy is actually an economy that has, huge production. Germany is running trade surpluses. Germany is actually producing, and it's producing heavily stuff. So it's an economy that's based on healthy fundamentals. Germans in general have always been extremely prudent with fiscal and monetary issues.
Not
extremely
always.
Prudent.
Yeah, you had the right.
I mean, by always, I mean, since then, yes. But since then is now what, 70 years? It's not a small amount.
Just a blink of an eye, 70 years, man.
Yeah, whatever, 60, 70 years. So anyway,
don't bring up that number to me.
Yeah. Anyway, so anyway you look at it, you can trust. You can trust the Germans to run a much tighter ship than the Americans. There's no question about it. No question about it.
All right, buddy. Well, I want to wish you a safe voyage, a great trip, and really, great to have the representation at this show with you three guys. You guys are like 3 drives to a bottom. I didn't think of that. There's 3. So, even though Blake's not making it, 3 is a number of completion. So, we have the triangle there. So, have a great time, buddy.
Okay, the 3 Musketeers are going to be there.
Yeah.
So see you there.
I like that one better than 3 drives to a bottom.
How about 3 drives to a top, Joe? I'd rather be bottoming out than topping out. That's why I chose. Huh? All right. Anyway, Joe, have a great time there. Enjoy. Much success. And Michael, thank you for your patience. It's your turn, buddy. You're on deck with baseball season upon us. I'm now making you the presenter. It's been a while since we've talked. I'm looking forward to our conversation, Michael.
Hello.
Hi, Michael. How are you, buddy?
I'm doing great. How are you?
Good. How long's it been? And I'm waiting to see your screen. You can share your screen here.
It feels, I think it's been about a year. Yeah, I'm just getting my screen up and loaded. Okay, show main screen. Which one is the main screen? I've got two screens.
Choose
I
one.
think is
Okay, there you go. There's a
is that it?
spreadsheet up there.
Okay, yeah, no, that's not it.
We got hot chick up there.
Yeah, those are some meme ideas for today.
That used to be my only idea a long time ago.
Hey, whatever. Oh, well, we all have things that get us going in the morning.
Yeah. So what got you going? It's been a year. Maybe you could refresh my memory, Michael, your journey into the business. What was your first gig in the biz?
Sure. So my first gig, I guess you could say, in the business was helping to run the New York City Investors Business Daily Meetup Group. That was almost a decade ago at this point, like give or take.
Yeah. IBD, it may be old school, but I think they're really the ones that really popularized knowing about relative strength and weakness. And it's something that I still use in my work today, trying to identify leadership and laggards. And by diagnosing that correctly, gives me an edge to be shorting or buying the right one based upon performance. Are you still a big proponent of that?
Absolutely. I've been so I've done some videos recently, stock A or stock B, and I've been posting those on Twitter and Instagram. And one of the comparisons yesterday was Johnson & Johnson versus Tandem diabetes care. I have those charts up. They're both in the healthcare space, but aside from that, like there's not too many other similarities among them. And you could even see like with the relative strength too, right? So relative strength, even from going back to December, you could see how Johnson & Johnson has been a laggard and kind of flattening out over here, even during its climb, while Tandem has been off to the races as far as relative strength. We're looking at weekly charts, and it's one of those things too where it just shows you like you want to be trading the leaders, or I should say that a viable strategy for traders that are looking for growth or momentum stocks want to be trading the leaders. And the easiest way to find leadership is to just take a look at the like what's beating the S&P 500 and making new all-time highs or new 52-week highs. And this is a great way to do it.
I wanted to ask you something else that is part of my theory and what I teach. Have you noticed when price and momentum confirms a new high, momentum's making a new high with price, that even if you get a correction, that markets rarely peak. You could get a high, but not the high, that markets rarely peak when momentum is confirming price, or bottom when momentum is confirming price. Okay.
I think that I think it's more nuanced than that. Like when I'm looking at the market, when I'm looking at individual trades, I'm trying to spot the trend. I'm trying to look for consolidations. Let me blow up this chart over here on Tandem. I'm looking at so there was this spike up, right? This move here. You could call it, say, a cup with handle, right? Like there's the cup, and then maybe that's the handle, or maybe like this. Some traders might see that as the handle too. Either one of them work. And then it blasted off after earnings.
Okay,
right?
well, I know it's your interview and not mine, but what I was talking about, look at the high in September on this particular chart before we move sideways and consolidate. So to me, the RSI was making a new high with that high.
Right.
So, I've renamed RSI from relative strength index to real simple implicator. So when a market's making a new high and RSI is confirming, to me, it implies that that's not the top. Okay. It could be a high, but the likelihood of another high is highly probable if momentum is confirming that move. And then as a trader, if I know I have confirmed highs or lows, I'm looking to buy a break after a confirmed high and looking to sell a rally after confirmed lows. Just that simple.
Yeah, that's interesting. I haven't looked at it that way.
We learn from everybody.
Yeah, no, like that's one of the great things that I love about shows like this and being on Twitter and StockTwits and Instagram and all these different places. I feel like there's so much that can be learned. But I also think that it's a matter of us figuring out how to take these things that are out there and apply it to ourselves, to our own trading style, to our lifestyle. And I think that that's actually where a lot of traders get confused. That you could get overwhelmed by so much information, and it's like, oh, well, what works? Well, honestly, like most of it works. It's not the system; it's the executioner.
That's right.
Be able to do.
It's who's driving the car, right? It's not the car. It's who's behind the wheel. Yeah.
Yeah,
Great
exactly.
point, Michael. So, do you take into account, as mainly an equity trader, what's happening with the dollar? Does it, that's our bailiwick here. Do you have certain groups that you favor during times of dollar strength that may be interest rate sensitive, etc., and times during dollar weakness? Does it come into play at all in your analysis?
Nope.
Okay, that's fine. And how about rates?
Nope, not really looking at that either. It's more so like, well, what I'm considering when I'm looking at market health, and all those things that you mentioned are important too. Like I coach other traders that trade Forex, that trade crypto, that trade baseball cards. It's like figuring out the handful of variables that are going to be important to that person, and figuring out, well, why are they important, and then sticking to a handful of variables and not introducing new variables into the process randomly. I think that if we start, like if say you convinced me that understanding the dollar and interest rates were super important and would help dramatically benefit my trading, then if I just did that once, then I would be doing myself a disservice because it's not a part of my process. But if I analyze my process and then I saw, you know what, this is something that I can apply universally in going forward, and then figuring out how can I work that in, then it makes more sense. But there's also a point too where you don't want to start taking on too many different variables. There's the study that was done back in the 70s that Adam Robinson quoted when he was on the Tim Ferriss show. And are you familiar with Adam Robinson?
No.
So Adam Robinson is right now he's a global macroeconomic advisor to some of the largest hedge funds. Some of his background includes being a chess grandmaster and coming up with the Princeton Review. He's one of the co-founders of the Princeton Review.
Okay.
And so he's on Tim Ferriss's show, and the study from the 70s was they took a bunch of gamblers that would bet on horse racing, and they said, okay, with no information at all, how accurate can you be? And they ended up being accurate 10% of the time. So that's their baseline. After that, they said, okay, we're going to give you 5 pieces of information, any 5 pieces of information that you want. Somebody might want the height and weight of the jockey. Somebody might say, I don't care about that. Tell me the last couple of races that this horse run and what were the conditions, yada, yada. Yeah. And so from there,
then you get to a point of diminishing returns of information overload, and because I get it all the time, I get a lot of things thrown at me, so makes my head explode. How about you?
Exactly, and not only that, it adds to confirmation bias. So when they finally get to the end of the study, right? Like, so when they had the 5 pieces of information, their accuracy increased to 17%, right? So they're 70% accurate, 70% bump in accuracy. They thought that they would be right 19% of the time, right? So 17% accurate, 19% where they thought that they would be accurate. So pretty good calibration. As they got more and more things that so they were like any 10 pieces of information, any 20, any 40 pieces of information, their confidence skyrocketed, but their results flatlined at 17%. So the only thing that more information does beyond a certain number is feeding your own confirmation bias. And so I think that's an important part for us as traders to realize too. We don't need more information. We need to be able to deal with uncertainty and manage risk.
I completely agree. So what's your risk management style, Michael? When you go into a trade, first of all, you're trading equities. Do you actually use physical stop loss orders in equities?
Yes, I do. Actually, let me correct that. I do in when I'm trading outright stocks. If I'm using options, it's a little bit different.
Yeah, you can't. I was talking to a mentee of mine. I mean, how to use a stop on an option when it's really, there's decay in there. There's all different types of variables, beta, theta. Kind of impossible to use a stop loss order in options, isn't it?
Yeah, it certainly adds quite a different dimension. Like you have regular equities that are sort of 2-dimensional, and then you have this 3-dimensional thing with options with like it was saying, the time decay and the added volatility and all this. So when I'm trading options, and this is a strategy that I'd like to share that has worked very well for me. I'm trying to figure out ways to make it work on other time frames. But the time frame that I'm using, or let me start by saying, the intention of this strategy is for income generation.
Okay.
Every week or every 2 weeks. And this has worked out very well. It's not one of those things where, you're guaranteed $5,000. Like, no, that's all nonsense. But this is a strategy that gives multiple ways to win. And the goal of it is income generation. So I'll look at a chart like, 10 might be a poor example because there's not really a good options market on it. But let me bring up Google, because this is one that I actually did this on this week. And so we have Google breaking out, right? So I see that Google is in this consolidation. It's starting to, it's trending higher. So at the beginning of the week, I'm selling put credit spreads down here.
Okay.
That expire at the end of the week. So
you're taking advantage of time decay, and you do it. Really, the decay the last couple of weeks is tremendous. So, what do you do if, say, for example, you're selling a credit spread, and say Google broke hard to 1060 during that time frame? What do? You just get out of the position, or do you roll, or what do you do to protect yourself? Because you're short something, right? You don't have limited risk on a credit spread, do you? You have unlimited risk.
Well, no, on a credit spread, your risk is limited.
Okay.
But so here's what I like to do with it, right? And this is how I give myself multiple ways to win in the trade. And it's not foolproof, but it's something that adds even more potential to the potential win, right? So let's say it does roll over hard. What I do, since this is a daily time frame, I cover on that first break, right? Like I'll cover the short side of it, and then I'll let the long side run, but I'm trading the long side of it on the 15-minute chart. Since it's breaking down on the higher time frame, I'm trading it on the shorter time frame, and I'm looking for, and I'm covering, and I'm looking to trade the pattern on that lower time frame, and then treat it as a day trade. So that's part one of making it potentially more profitable. That could end up generating a bigger loss, but you already know what your risk is going into the trade with the number of options and spreads that you put on.
Okay.
The second way,
go ahead.
The second way that I reverse this, so like let's say it does break down, I'm doing that, plus then I'm selling call credit spreads above resistance.
Okay, I see. All right. I have a more general question. You know, we had that, you know, the worst December, Michael, since 31. And we've had a, 8-10 week rally. And it's been a, you know, tremendous rally. And I'm starting to get signals on a weekly basis, if we don't recover, of an outside week to the downside. What's your view of the position that the market's in right now? Is it possible that we correct half of this recent advance from the late December low? Are you getting any kind of readings or indications from things that you follow that say this market is long in the tooth and could set back here?
Well, I like to think that anything's possible, so it's best to prepare for anything.
Okay.
I think that where we hit resistance is a pretty logical point. So the way that I gauge the health of the market is by first looking at the major indexes, the NYSE, the Dow, the S&P 500, the Russell, and the NASDAQ. And I'll see what they're doing across time frames. So right now I have the weekly time frames up, and the NYSE broke out last week. It found resistance this week. Why could that be? To me, I believe that the indexes work in tandem with one another. And whoops, my screen just...
You know what I noticed here this week, Michael? I want to see if you see it too. From the last big decline that we had late last year, and you know, the Russell led it to the downside. The Russell bottomed first and led the recovery to the upside. And this week, it looks like the relative weakness between all the averages that you pay attention to, the Russell is a weakness. So, you know, it's almost like a repeat of the same process. So do you consider the Russell kind of a leading indicator for the rest of the market? When it's showing relative weakness, that's a warning sign. And when it's showing relative strength, it means something completely the opposite? Compared to the other averages.
Some that, and it'll change. Sometimes the Russell's leading, sometimes the Dow's leading. I think that helps to me. When I'm doing so I'm starting at this top level analysis with the indexes. If I see that the Dow is leading the way and the Russell is lagging, then it's like, oh, maybe the bigger caps are doing something, and so they'll be more on the radar than the smaller caps that you would find in the Russell. When but it's just part of it. Another part of the analysis is what are the number of new highs versus new lows look like. So when that's what this indicator is down here. So if we look back to October of last year, we started to see the number of new highs, the green, start to really dry up, and maybe I can make that a bit bigger.
Oh yeah.
Yeah, so you see the number of new highs start to dry up as we started to come in, and then the number of new lows start to rapidly expand. And that's something that I've seen as a leading indicator, or just something as that would indicate that something could potentially change, right? When we started to rally up the bottom, look how dramatic the new lows just dried up.
Yeah.
Then we started to progressively see new highs start to come in. And to me, it makes a lot of sense. It makes sense that the market cannot continue to move higher if the stocks within it are not making new highs. Same thing if new lows.
I like this indicator. It's not early, but it's maybe a little bit longer into the progression of the move, but the confirmations are excellent. New highs, new lows. I'm hearing people talk about that. Some of these breadth measures aren't as true as they used to be because of ETFs and other reasons. Do you? The advanced decline line that people pay attention to, it's not the same advanced decline line we had before. I believe ETFs was a reason for not trusting it as much. Do you have any thoughts on that? So I agree with the statement. And it's also why I think that there needs to be a third part of market health. And the third part of it is what's your watch list telling you? What are the stocks in your portfolio telling you? And I think that that's the most important part of it all. Okay, Michael, why don't you take if you wanted to finish? I'm sorry I interrupted again. Go ahead.
No, that's okay.
Now would be a good time to show you have a great looking website. I've been there. You coach, you write a newsletter, you mentor people. What would be the best way for people to get a hold of you? Besides your Twitter handle, which is your name?
Yeah, so they can find me on Twitter at Michael G. Lamott. They could come to Mara Wealth. The website's up here, and it looks like I'm logged in. So let me log out.
What does Mara stand for?
So it's actually we got that name from my marathon running.
Okay.
I see wealth as a journey. It's
that.
One of those things where we hit a wall. I've hit that wall in my own trading. And as a marathon runner, when I ran my first marathon, I hit the wall at I think it was mile 19 or mile 20 in New York City. It's right when you get into the Bronx, right? So imagine you're like running through the entire city, and you're in Manhattan, and there's millions of people out there, and people are cheering for you. I have my name on my shirt, so people are saying like, "Go, Mike!" as I'm running past, slapping hands with people. And then all of a sudden, you get out of the Manhattan, and you're into the Bronx, and the first thing you're greeted with is this steep bridge to get into the Bronx. And then after that, it's by comparison, it's almost a ghost town. Right, like where you have millions of people like on the side, then you have like maybe like 5 or 10 like kind of scattered around block to block, and you're spent at this point. And my legs would not move. And during my first marathon, I actually started to like break down in the middle of the street and cry because I thought that like all this and my I can't do it. Like my legs just won't move. And
what a great story.
Yeah, and then thank you. After that, I start yelling at myself. After a moment, I start yelling at myself, "No, keep going." And then, somehow, I will my legs to start moving again. And I see that as the spot where a lot of traders get to. A lot of traders, they crack open these books, they try to apply it, and they get to this point where they're just hitting the wall. And they need help. They need help getting over the wall. And so because I'm somebody that's learned how to trade part-time first and going to the IBD meetups and then becoming a leader there, and then getting to the point where I was finally able to leave the day job to come do this. And by this, I don't mean just being a full-time trader. I mean coaching others. That's the passion. That's the fulfillment. I want to help them over that proverbial wall.
And let me ask you this, Mike. What a great story. Do you, because we both do this, do you feel even more satisfied with your students' victories than you do with your own?
Oh yeah, absolutely.
All right,
Absolutely.
I just wanted to make sure I wasn't crazy or anything. So, I mean,
Well,
seeing
you might
someone,
be, but not for that reason.
and anyway, just seeing people that you teach, and have you experienced that the student becomes the teacher at times as well?
Always,
Oh
always.
man,
Every time when so I learned that early on. Well, when I first started doing the meetups, right? Like to go back there, like you're putting together these kinds of presentations, and you're doing a more thorough analysis because you're getting ready to present and share stuff with other people. So there's that pressure, and then you get the questions during and after the presentations, and it gives you different perspectives, different angles to see different things with. And I get that from presentations, from workshops that I'm doing now, to the one-on-one coaching calls too.
Yeah. I tell you what, Mike, what a great interview, and what a great story you about, and an analogy and metaphor of this being a marathon, because, I'm still doing it after 40 years. And, when I first started, a veteran pulled me aside and said, "Kid, this is a tough way to make an easy buck." And you know what? 40 years later, he was right. And I'm just starting to get good at it. Anyway, buddy, you're my trading warrior brother. And, may any distance you choose to run, that you have the wind at your back for you and your students, that great trades just rain down on you and everyone that you work with. And thank you so much for coming and sharing with us today in Face, Michael. It's been really a pleasure. Thank you, buddy.
Thank you. Quite a pleasure. Look forward to speaking with you again and tuning in soon.
All right. Michael Lamoth, why don't you give the website one more time? Mara, like marathon?
Yep, marawealth.com. There's a lot of great information on there, a lot of free goodies for people. Some of them are like this one down here, the Trader's Thought Box. That's a summary of the top 10 things that I've learned since starting on this journey 20 years ago. This trade tracker is the PDF that I fill out on every single trade. So it's a trading journal. I ask myself a series of questions ahead of every single trade just to get me into the right mindset.
Yeah. Right.
And yeah, like things like, how do you feel right now? Right? If you're not in the right state of mind when placing a trade, like if you're coming from a trade from a place of fear, anger, greed, like that. How many decisions do you make from that kind of a place?
You're right. That's everything. So, there again, being a runner and being a trader, you're always do better in your peak performing state. If you're sick and you have a lot of things on your mind, the market will still be here and just step aside for a while. Do you agree with that?
Yeah, absolutely. There's always another bus coming.
I like that. So we'll wrap it with that. Michael, and thank you so much for being with us today. And I really enjoyed our conversation. Hope you did too. And yeah, that's a wrap for our show today, everybody. Good hunting. Remember, don't just count your pips, count your blessings. And just like Michael, everyone, good luck in running your race. Adios, and I'll see everyone tomorrow. You're welcome, Alina. And thanks once more, Michael. Good hunting, my trading warrior brother.
Thank you. You as well.
Thank you, buddy.